If you like to visit a certain grocery store in America, you might want to listen up. Reports have been circulating that this beloved supermarket chain is on the brink of collapse, with insiders claiming that it's only a matter of time before their doors close for good. Never before have the problems been so great for these chains, and some are on the brink of collapse. Is there any possibility that they will survive this turbulent time and not have to close their doors? The supermarket industry has been hit hard by recent economic downturns and increasing competition from retail giants like Walmart, Target, and Amazon-owned Whole Foods. While some big-box retailers have seen massive sales increases during the pandemic, many specialty grocers have struggled with supply chain disruptions, labor shortages, disorderly mergers and acquisitions, and huge piles of debt. One such grocery store that has been hit hard is Albertsons. Albertsons, a major supermarket chain and parent company of Safeway, Shaw's, and Acme, is at high risk of default, according to Rapid Ratings Financial Health Ratings. Last year, the company announced it couldn't cover pension plans for 50,000 workers in the Washington, D.C. area. This has made it difficult for the company to go public, and it is currently in talks to merge with Kroger and another struggling grocery chain. However, the future of both companies remains uncertain. Safeway, which has 897 locations nationwide, is facing internal turmoil with supply chain shortages, labor constraints, and declining sales in some stores in Washington. This is all happening as its parent company, Albertsons, faces financial difficulties. Some Safeway stores have already closed, and analysts predict that dozens more may follow as Albertsons restructures. Southeastern Grocers, the Jacksonville, Florida-based parent company of the popular Harvey's supermarket chain, has announced plans to sell off multiple brands as the U.S. economy braces for another recession. The struggling company is currently conducting going-out-of-business sales in 30 locations across Florida, Georgia, and the Carolinas. Despite Harvey's long-standing reputation for offering competitive prices and quality goods, it may not be immune to the challenges facing the retail industry during this time of reduced consumer spending. The company's decision to cut costs by closing stores and selling off underperforming brands reflects the broader economic uncertainty facing the industry. WinnDixie, a popular supermarket chain, is reducing its footprint and laying off employees as it struggles with soaring debt, revenue losses, and pressure from vendors. Industry analysts are skeptical that even a slimmed-down WinnDixie can compete with larger competitors like Publix and Walmart. The company plans to exit lease obligations for underperforming stores and work on initiatives to improve sales during the reorganization period, but it faces an uphill battle. In 2018, Bilo, a well-known supermarket chain, encountered difficulties in meeting earnings expectations, which resulted in the closure of 100 stores. However, in 2020, the parent company managed to sell 62 stores to Food Lion, a grocery store chain. Despite this positive development, the company announced the closure of 23 more stores in 2021, indicating that Bilo's future prospects remain uncertain. The fierce competition from other supermarket chains such as WinnDixie and Fresco adds to the company's challenges. With this in mind, Bilo will need to implement a sound strategy to remain competitive and stay afloat in the ever-changing retail landscape. King's Food Markets, a regional grocery chain based in New Jersey, encountered a significant decline in its operations due to the bankruptcy of its parent company, KB US Holdings. The latter's financial distress was a result of various factors, including low earnings, escalating labor costs, and rising pension obligations. As a means to repay its outstanding debt of $114 million, KB sold off its major store chains, but continues to experience long-term liquidity constraints, despite receiving a $20 million bankruptcy loan. King's Food Markets, along with its loyal customer base, faced the brunt of the bankruptcy, resulting in the closure of several stores and a decline in revenues. The Fresh Thyme supermarket chain, which originally aimed to carve out a niche in the natural and organic grocery market, has been struggling to compete with larger and more established supermarket chains. Despite reporting some growth in the last quarter, Fresh Thyme has been forced to close several stores due to fierce competition and a lack of differentiation from conventional grocers. The chain's failure to resonate with shoppers has been attributed to its inability to offer the same one-stop shopping experience and low prices as its larger competitors. These challenges have led to a decline in earnings and a shrinking market presence for Fresh Thyme Earth Fare, a popular natural foods grocery chain, was forced to file for Chapter 11 protection in 2020, resulting in the closure of all 50 of its stores across the United States. The main reason for the closure was the company's inability to refinance its substantial debt of $138 million. Despite receiving a credit of $78 million, Earth Fare was unable to sustain its business operations. Although there were initial plans to reopen some of the locations with the help of Whole Foods, those plans have yet to be executed, leaving the future of Earth Fare uncertain. Founded in 1975, Earth Fare was known for offering a wide variety of organic, non-GMO, and environmentally friendly products. The company was committed to supporting local farmers and providing its customers with high-quality, healthy options. Despite its popularity and loyal customer base, Earth Fare struggled to compete with larger grocery chains and online retailers in the increasingly competitive natural foods market. With the closure of all its stores, the era of Earth Fare appears to have come to an end, leaving a significant gap in the natural foods market for consumers. Family Dollar, a leading discount store chain in the U.S., has been facing significant challenges in recent years. In 2019, the parent company, Dollar Tree, closed nearly 390 Family Dollar stores as part of a strategy to revive the brand's flagging fortunes. However, despite this effort, Family Dollar has continued to suffer losses, reporting a staggering $2.31 billion loss in a single quarter, compared to a profit in the previous year. The company's troubles were further compounded in May 2022, when a significant rodent infestation forced the closure of 404 stores. This development came on the heels of a former employee in Maine putting up a pink sign alleging poor treatment by the company. These challenges have prompted Dollar Tree to embark on a series of store closures and relocations as the company attempts to turn the tide and revive the struggling Family Dollar brand. Save-A-Lot, a discount grocery store headquartered in St. Louis, has been undergoing a significant transformation by shifting its business model from retail to wholesale. The company aims to cut its corporate debt by $400 million through this restructuring process. As a part of its revitalization plan, the company has sold off 300 of its stores to independent retailers. However, this has left some shoppers devastated, as they are left without nearby alternatives for their grocery needs. The transition to a wholesale model is crucial for the company's survival, as it will allow it to focus on its core competency of providing high-quality grocery products at lower prices. However, navigating this complex transformation is a challenge, and the company's future remains uncertain. Furthermore, the ongoing recession caused by the COVID-19 pandemic may further complicate Save-A-Lot's recovery plan. The economic downturn has had a significant impact on consumer behavior, with many people cutting back on discretionary spending. If the company is unable to successfully navigate these challenges, it may face another wave of closures, which could further jeopardize its survival. Lucky's Market was once a popular natural foods chain in the United States that was known for its affordable prices and diverse range of food staples. The company's unique approach to retail, which included a focus on organic and locally sourced products, made it an attractive option for many consumers. However, despite its initial success, the company eventually faced tough competition from larger players in the industry. In its latest fiscal year, Lucky's Market suffered a net loss of approximately $100 million, which was a significant decline from the previous year. The company also faced a 10.6% drop in sales, which put a strain on its financial resources. To make matters worse, Lucky's Market was unable to keep up with its debt obligations and was eventually forced to file for bankruptcy. As a result of the bankruptcy, Lucky's Market was forced to close 80% of its stores, resulting in the loss of over 3,100 jobs. Today, only 6 Lucky's Market stores remain open. Despite these challenges, the company continues to provide natural and organic foods to its customers, who appreciate its commitment to quality and affordability. Fresh and Easy, a British chain that entered the U.S. market with hopes of competing with American food retailers, accumulated debt of up to $1 billion. The downturn of the past couple of years made it lose approximately $22 million a month. The company filed for bankruptcy for the third time in 2020 after its first filing in 2013 and the second in 2015. Parent company Tesco is trying to sell 30 stores after closing 12 locations across the nation. Fairway Market, a renowned gourmet grocery store in New York, has been facing financial difficulties for several years. Despite filing for bankruptcy in 2013, the company managed to make a comeback and regained its position as one of Manhattan's most popular grocery stores. However, the company's financial struggles persisted, leading to a staggering debt of $174 million. As a result, Fairway Market had to file for bankruptcy for the second time in 2020. To mitigate the financial crisis, the company sold some of its stores to Village Supermarket, the parent company of ShopRite. Today, only 9 Fairway Market locations across 3 states remain open. ShopRite, a supermarket chain owned by a cooperative of independent retailers, has been serving local communities for over 8 decades. Established in 1946, the company has grown to become the largest retailer-owned cooperative in the United States, with over 300 stores across the country. Despite its success and reputation for providing quality products and services, ShopRite has been facing some challenges in recent years, particularly in the New York area. The retail industry has become increasingly competitive, with online shopping and discount retailers taking a significant share of the market. Additionally, rising costs of operations such as rent, wages, and utilities have put pressure on the company's profitability. As a result, ShopRite has been forced to make some difficult decisions, including the closure of some of its most iconic locations in the New York area. The closures have been met with disappointment from local communities, as these stores have been an integral part of their neighborhoods for decades. ShopRite has assured its customers that it remains committed to providing quality products and services to its customers, and that it will continue to explore new strategies to remain competitive in the market. Piggly Wiggly, the first self-service grocery store in America, opened its doors in 1916. Marking a major shift in the way people shopped for groceries. The founder, Clarence Saunders, introduced several innovations that changed the retail landscape forever. Instead of having customers hand their shopping list to a clerk, they were given shopping baskets and allowed to select their items themselves. This saved time and allowed customers to browse the aisles at their own pace. The Piggly Wiggly chain rapidly expanded across the country, with over 600 stores in operation by the 1930s. The chain's distinctive pink and green logo, featuring the jovial Mr. Pig, became a familiar sight in communities across the United States. However, in recent years, the Piggly Wiggly chain has faced several challenges. Labor shortages have led to the closure of several locations, including some that have been operating for decades. In 2011, a number of Piggly Wiggly stores shut down due to a lack of workers, and more closures have occurred in the first half of 2022. Despite these challenges, Piggly Wiggly remains an important part of American retail history. Many people still have fond memories of shopping at the store and appreciate its pioneering innovations. While the chain's future may be uncertain, the legacy of the original self-service grocery store lives on. Despite being considered Whole Foods' closest competitor, Sprouts Farmers Market is currently facing significant challenges. The company's stock has fallen by over 24% since the beginning of the year, losing about $1 billion in market capitalization compared to a year ago. The outlook for small and regional grocery stores is becoming increasingly challenging, and Sprouts has already closed several underperforming locations. Further closings are expected in the coming quarters as the company struggles to meet its financial goals in a rapidly changing digital food retail landscape. Shoppers, a grocery chain based in Providence, Rhode Island, has closed many of its doors in recent years. Its parent company, United Natural Foods, sold or closed most of its stores in an effort to exit the retail business. Lidl, a popular German discount grocer, purchased many of the remaining Shoppers locations during a liquidation sale. Currently, only 14 Shoppers stores remain in the Washington and Baltimore regions, with devotees of the brand expecting the remaining properties to close within a year to 18 months. In September 2021, Stop & Shop, a well-known supermarket chain, made an announcement that shook the residents of Little Neck, New York. The company confirmed that it would be closing dozens of its underperforming stores, including the Little Neck location. This decision came after 8 months of announcing the store's closure, leaving almost 2,000 customers in shock and disappointment. Despite the significant number of people who signed a petition to protest the closures, the company stood firm on its decision. Many customers in Little Neck were left without an alternative option for grocery shopping, as the nearest Stop and Shop stores were miles away. The closure of the Little Neck store had an adverse impact on the community. It was a convenient option for residents who could not travel long distances to other grocery stores. Moreover, the store employed over 100 people, and their jobs were lost due to the closure. The decision to close the Little Neck location was a part of Stop & Shop's broader strategy to shut down underperforming stores and focus on more profitable locations. While the closure was a significant setback for Little Neck's residents, the company's decision was a strategic move to optimize its operations and remain competitive in the highly competitive retail industry. Sam's Club, a membership-based warehouse club, has faced significant challenges in recent years. The company experienced a dramatic drop in revenue in 2015, despite implementing the loss leader strategy to attract small business owners. This strategy involves offering goods at a price lower than cost to attract customers, with the expectation that they will purchase other items at full price. However, the approach did not generate the expected results, as most members only use their memberships for personal shopping instead of for their businesses. The COVID-19 pandemic further impacted Sam's Club as it temporarily closed hundreds of stores, leading to a significant loss in profits. Although the company has seen a surge in online sales, it needs to adapt to changing market trends to remain competitive in the retail industry. The closure of 63 stores in 2018, which left many employees suddenly without jobs, was a wake-up call for the company to reassess its operations and stay relevant. The retail apocalypse is hitting specialty stores hard, leaving shoppers with fewer options and more vulnerability to price hikes. In 2021, 1.3% of U.S. supermarkets closed permanently, and that number could rise by another 6% in the next 4 years. E-commerce is gaining ground as grocery costs continue to soar and companies struggle with real estate, labor, and supplies. Grocery inflation is here to stay, and this crisis is just beginning. Thank you for watching, and we welcome your feedback.